In this lecture, we'll talk about break-even analysis. A break-even quantity is calculated or is equal to the fixed cost divided by the contribution margin. If you expect to sell more than the break-even quantity, then the investment will be profitable. The break-even quantity is therefore the amount that you need to sell in order to cover your costs. At this sales level, the profit is exactly equal to zero. We can derive the expression here for the break-even quantity. Q equals the fixed cost divided by the term in parentheses. And the term in parentheses is the contribution margin. It's equal to the price minus the marginal cost. The contribution margin is really what's left over after marginal cost has been met in order to contribute to covering the fixed costs. Let's take an example of Nissan. Nissan was contemplating the redesign of its popular Titan truck model that had only 2 years left on its production cycle. The cost of redesigning the Titan was estimated by Nissan's engineers at about $400 million. Nissan's cost of capital was 12%, implying an annual fixed cost of about $48 million. That's the 400 million times 0.12. So the annual fixed cost of redesigning and paying for this redesign would be about $48 million. Now, Nissan knew that the contribution margin on each of its trucks was about $1,500. And we can use the formula from the previous slide to find a break-even quantity. The break-even quantity is equal to the fixed cost, in this case about $48 million, divided by the contribution margin, 1,500, and that works out to be about 32,000 trucks that Nissan would need to sell each year to break even on its redesign project. In other words, to cover the cost of redesigning. Now, Nissan at that time had only about a 3% market share, and that translated into sales of about 12,000 Titans per year. Not nearly enough to break even, not nearly enough to justify the $400 million redesign project. Instead, what they decided to do was license the Dodge Ram pickup, which would reduce the fixed cost of redesign and lower their break-even point. Now, after the government took over Chrysler, Nissan sort of probably had some second thoughts on this, some buyer's remorse, but let's focus on the break-even quantity analysis and what that licensing of the Dodge Ram truck did to lower the break-even quantity for Nissan. The cost of licensing the Dodge Ram worked out to be $80 million, and the annual cost of that, assuming a 12% cost of capital, worked out to be about $9.6 million. If the total fixed cost is $9.6 million, and they're still making about $1,500 per truck, that works out to be 6,400 trucks, or truck sales per year, necessary to cover the cost of the redesign. That was much lower than their 12,000 truck sales level, and so the break-even quantity associated with the licensing of the Dodge Ram, 6,400 trucks, was something that was attainable. In this case, Nissan used break-even analysis to identify the quantity that they needed to sell, the number of Nissan trucks that they needed to sell in order to add economic value or make an economic profit. A second example is a 1983 example when John Deere was in the midst of building really a Henry Ford-style production line factory for large four-wheel drive tractors. At that time, some of you may have been alive in the 80s, some of you not, but if you think back to the 1980s, there was a dramatic reduction in prices of many commodities. Many farms failed, many farmers went bankrupt, wheat prices fell dramatically, and the demand for large tractors at that time plummeted, went way down. John Deere at that time decided to abandon the new factory that they were beginning to build and instead purchased Versatile, which was a company that assembled tractors in essentially a large garage using off-the-shelf products. Now, this was a discrete investment decision. The factory that Deere had originally contemplated had large fixed costs and smaller marginal costs. Versatile had smaller fixed costs, they had a smaller scope of operation, but larger marginal costs because they were using off-the-shelf products. Now, was this a good decision or not? Well, the advantage meant that the company could reach their profitability sooner, and in an era where demand for the particular tractor that they were marketing had fallen, it made some economic sense to go with a lower fixed cost and higher marginal cost investment strategy. The break-even quantity in that case turned out to be much lower. So John Deere also utilized a form of break-even analysis in order to make that decision to abandon their large production facility and go to acquire a smaller scale production facility firm. Remember this advice: don't use break-even analysis to justify either higher prices or higher output. Now, managers will often reason that they need to raise prices to cover fixed costs. This is wrong. This is going the wrong direction because fixed costs do not vary with the pricing decision. Similarly, sometimes managers will reason that since the average fixed cost declines with quantity, they need to sell as much as they can in order to reduce the average cost. Both lines of reasoning are flawed because pricing and production are extent decisions that require marginal analysis, not break-even analysis. So remember that break-even analysis can be useful. It can identify that point that we need to reach in order for profits to go from negative to positive in order to turn that corner, but they should not be used as a framework for pricing and production decisions. Only marginal analysis can be used properly to gauge or identify the optimal level of production or the optimal price level. Thanks for listening.